Most retail traders have a very poor understanding of fundamental economic data that is dropping in the financial markets and how and why it causes price to move a certain way. Most traders just look at news candles as, oh, I either don't trade those or I love trading those, and they're just big spikes and it's pretty manipulated, so it just goes in a random direction. There's no telling what it's going to do. But that right there is actually just straight up laziness to actually understanding economic data. So in today's video, I'm going to show you how to read incoming economic data to decide whether or not it could impact a chart positively or negatively, whether you trade FX, indices, commodities, or stocks. First and foremost, the reaction to news in markets is almost always a rational one. It's just that retail traders typically have a fundamental misunderstanding of how the data actually impacts the markets. So today what I'll be doing is I'll show you what actually matters to markets and helps to decide whether or not the market moves higher or lower following a data point that was released. For example, let's say we're looking at the GDP growth of the United States quarter over quarter, and the data is expected to come out in the next few days. What most traders will do is they'll pull up something like forexfactory.com to watch the data come out, and they'll just see a green or red number, and that's enough. They start looking at it and say, oh, it's going to go up, or oh, it's going to go down. But in reality, what we really want to do when understanding economic data reports is to understand the surprise factor. The markets are quite intelligent. And what I mean by that is that ahead of a GDP statistic dropping, or a retail sales number, or a CPI figure, or wage growth statistics, non-farm payroll, before all these data points come out, the markets are actively trying to predict or forecast what those data points are likely to be. Now, how are they trying to forecast? How do they know what NFP is going to be? Well, again, this is where a lot of retail traders have a critical error in their trading, where they kind of underestimate how intelligent the financial markets and the pros in this game are. So ahead of an NFP event, right, the jobs data or GDP growth statistics dropping, there are teams of very intelligent data scientists and PhDs in computer science, floors of very intelligent people at big banks like JP Morgan Chase, all these financial institutions that are trying to carve out and predict based on millions of inputs what these data points are going to be before they hit the markets. Because if you think theoretically, if you knew where GDP numbers and NFP numbers were going to be beforehand, there's a lot of money to be made. And these giant financial institutions pour millions upon millions of dollars into research to discover this. Again, this is where there is a fundamental underestimation by retail traders about how intelligent markets are, and why it truly is hard to predict the markets is because there's very intelligent people trying to do so constantly. But it does not mean that it cannot be done, and it also doesn't mean that there isn't something here for us to potentially trade off of. What we ultimately want to do is we want to keep an eye on these reported forecast numbers relative to what actually appears, because although there are some really intelligent people trying to predict what these numbers are going to be, it ends up being a very difficult problem to solve, and there are still times in which they get it wrong. When they get it wrong, what I mean by that is when the forecast, the consensus across Wall Street is for a certain statistic, but then the actual data comes in vastly different, that is where you get those substantial spikes one direction or the other. Sometimes retail traders will say, well, hey, the number came out better than expected and it didn't move anywhere. It just chopped back and forth. The market's manipulated. But in reality, what you'll find is most of the time when that is happening, it's because data points dropped in line with expectations, so the market was already priced for those levels. On August 1st, we had an example of a sharp surprise in jobs data in the United States. You can see the reaction here was a clear and evident huge move in the euro dollar higher, meaning the euro strengthened relative to a weakening US dollar. And on our economic heat map, we can see exactly why this is. If we take a look at the forecasted data for the jobs report, it was 110,000 jobs were expected to be added to the economy, but just 73,000 came in, which was a negative surprise of 37,000 jobs. This was bearish for the dollar. And in response, we saw the euro dollar jolt higher as the euro appreciated steadily against the US. If the data point had come in largely in line with expectations, usually you'll see movement like this in the candle, where it shoots in both directions and really moves nowhere as people just sort of de-risk potential trades or bets that they had on or buy back into a position after the data point releases. Typically, we call these kinds of moves a volatile, spiky, kind of messy candle, but in reality, it is simply the data point that came out pretty much matched in line with expectations. Again, going back to my comments earlier, which may have sounded a little bit harsh, I truly believe that this is why a lot of traders will just say, oh, it's all manipulated, instead of putting in the work to actually understand what the data that dropped tells us about the economy and putting in the work to fundamentally understand how that could impact the chart going forward. Instead, people like to just say, oh, it's just market makers grabbing everybody's stop losses, which again, in my opinion, is disrespectful to the vast amounts of intelligence that are in the financial markets at any given time. So let's get back into our economic heat map for a second, and let's talk about how we can actually read this logically. So a lot of this stuff is learned through a lot of experience, and it takes time to understand how each of these impacts the specific chart. Like if you trade gold, or you trade the dollar, or you trade an individual stock, or you're trading indices, all of these things have slight variations of how they impact things. Our software here, the Edge Finder, which I'll leave linked in the description down below if you want to check it out or try it out, all the information can be found in the description for the tool that I'm using. We build these tools to make this stuff easier to track and easier to understand. In fact, what we've already done is we've created an impact column for both stocks and the US dollar. Another way to read this is if you're a gold trader, just flip the impact of the US dollar, and that will give you kind of an outlook in terms of how these data points are impacting gold. And what we do is we specifically compare forecast versus actual data, because this is what is cutting edge moving the markets. If, for example, you get a GDP number that came in better than forecasted by 0.5%, that is a bullish surprise for the US dollar and for the stock market, because growing economies are good for both. Conversely, we had manufacturing and services PMIs both miss their expectations. You can see that they were forecasted to come in at 49.5 and 51.5 respectively, and instead we missed both. The surprise to the downside was bearish for both the US dollar and for stocks. Additionally, we had retail sales numbers that came in under the expectation, causing a negative impact on the US dollar and the stock market. Now remember, if you're a gold trader, these bearish US dollar impact readings are actually bullish for gold. Now, the reason having a heat map like this is so important is that any one of these data points without the rest of them is not nearly as useful as having a holistic view of the US economy. This is what the Federal Reserve looks at. This list of stuff that we're looking at here is a heavily drawn upon list of data points that the Federal Reserve uses to ultimately decide what they want to do with monetary policy, aka hiking interest rates or cutting interest rates, also known as essentially the big money printer. Right? The money printer goes on or off, that causes stimulus into the economy. And these data points are really important indicators as to whether or not the Federal Reserve is likely to be more restrictive or less restrictive in regards to the economy. Now, I know that each one of these topics deserves its own videos, and so I've actually already done that. There's a playlist that we'll leave linked in the top right hand of the screen if you want to go through all of these data points that we've done videos on this channel about in particular. So if you want to learn about PMIs, retail sales, inflation statistics, I've got videos on all of those, and I would encourage you to just bookmark that playlist for future reference. And I would highly encourage you that if you are looking to trade with economic data, you need the right tools in front of you. This data is too hard to watch all at once just on the top of your head. You need tools in front of you that are automatically watching each of these data points and creating a surprise quote unquote index for your stocks and US dollar impact charts like this. This really saves the day because it makes it easier. Now I know obviously that's a sales pitch, but that is why we're in business. We build these tools. We have traders around the world using our tools. And I think this product really makes this process a lot easier for people who know that fundamental analysis is important, but they lack the tools to properly track it. So like I said, check it out down below in the description if you're interested in getting a copy and playing with it further. One of the most common questions I get on my channel is, Nick, how do I become a funded trader? Well, we just put together something pretty cool and it is available for free. We just put together a course, a full free course on how to trade with prop firms and how to get funded and stay funded. If this is something that you're interested in, again, we've got topics like the complete guide to getting funded, why most traders fail at funding programs and things you should know, how long does it actually take to get funded, how to keep your funding once you are funded, trailing drawdowns, and how to choose the right prop firm for you. This guide is completely free, and all you have to do is use the link in the description down below to fill out that form, and we'll send you a copy of the course completely free. Thanks for watching, and we'll see you next time.